Tuesday, February 28th, 2023, Monaco 64, home of alternative economics and contrarian views. So before I start today, I'd like to thank all of you, all the new subscribers, new viewers for your interest in the channel, and of course, the long-term supporters of the channel. And if you're new to the channel, make sure you hit the little notification bell if you've subscribed already to be notified of all my new videos. I make one every day. Make sure if you like a particular video that you hit the like button, and yeah, try to share as well with friends, family, people who you think might be interested in what I have to say. And talking about what I have to say, today we're going to look at the 2008 crisis and what happened there, because it looks like we could have something very similar happening. And derivatives, of course, were a big part of the '08 crisis, and I have a derivatives file. If you want to learn more about derivatives, it's on the playlist of my YouTube channel. There's many videos there. But basically, Wall Street built a house of cards around mortgage-backed securities, especially the subprime mortgage-backed securities. The rating agencies basically rated these AAA, even though they were far from being AAA, because they layered them, they packaged them. They had AAA loans alongside with very crappy loans or subprime loans, and they did a little salad there and said, oh, this is a AAA mortgage-backed security. And of course, investors were encouraged by the big Wall Street banks and City of London banks to invest in these derivatives, because they thought, wow, it's great, especially pension funds, all kinds of funds, hedge funds from all over the world. A lot of people lost a lot of money, retirement funds, I think in Norway, everywhere. And it didn't just start with Lehman, though. It started back in '07 when we saw these small subprime lenders, mortgage lenders, start going bust. And now we're starting to see subprime auto lenders going bust. And this is what Zero Hedge reported yesterday, actually. So we're going to go through this. And don't think that there isn't a huge derivatives market on the back of this. These are called asset-backed securities now. During the '08 crisis, it was the mortgage-backed securities. And I'm going to put also a link to Investopedia article about what asset-backed securities are. And you can bet that Wall Street, the City of London, they probably trade billions. Well, actually, yeah, could be trillions of derivatives on the back of that. Because I just wanted to show you here before we go on to the Zero Hedge article. This is from July 29th, 2022. Auto loan debt reaches a record $1.4 trillion. Yes, that's T with a trillion. So yeah, the derivatives market usually leverage on the back of the underlying market. So you can imagine what a mess it is. I don't think there are official numbers about ABS derivatives, asset-backed securities derivatives, because they're probably traded over the counter. So let's go to the Zero Hedge article then. Subprime auto lender and used car retailer collapses as distress cycle finally arrives. The other thing I would say, this shows that, is the US economy really doing well if this kind of thing is happening? No. A lot of the people that I speak to and some people that I used to work in the bond market in the city of London, they're saying we're going to have a recession. This inverted yield curve, especially how much it's inverted, is pointing to it. Anyway, says here, 1 month ago, when discussing the perfect storm hitting the US auto market, we showed that according to Fitch, more Americans can't afford their car payments than during the peak of the financial crisis. Guess that means the '08 crisis. So it says here the percentage of borrowers at least 60 days late on their car payment is rising. And that's from Fitch, of course, which was to be expected. After all, the latest consumer credit report from the Fed revealed an exponential spike in the amount of new car loans, which increased by more than 2,000 in 1 quarter, just over $38,000, a record, to 40,155, a new record. And you might think, well, it's a much smaller market. Mortgages were much bigger in the '08 crisis, but just the whole leverage is the problem. So let's continue the derivatives on top of these. And yet something just didn't click. If so many subprime Americans were saddled with record amounts of auto loans, on average more than 40,000, where were the defaults? After all, the average loan rate for new car loans just hit a 13-year high and will soon rise to the highest level this century. So you see how Treasury yields and rates are important. It's what prices all of these interest rates or yields in these ancillary markets. Well, after a lengthy period in which nothing seemed to happen, suddenly the dominoes are starting to fall. And as Bloomberg reports, used car retailer and subprime auto lender, American Car Center, told employees the business was closing its doors. Just 1 day after the company had hoped to pull off a funding Hail Mary by selling a $222 million bond, which failed. What's selling a bond? Well, it's basically trying to borrow the money through the bond market. You sell the bond to investors and they lend you the money. According to Bloomberg, the used car retailer, which targets consumers regardless of their credit history and thus targets almost entirely subprime borrowers who can't get a loan elsewhere, said in an email to employees on Friday the firm was ceasing all operations, closing its headquarters in Memphis, Tennessee, and that all employees would be terminated by the end of the business day, the people said. It employed about 288 people at its headquarters. The closure email came a day after the company sent another message to staff saying management and advisors had been working with lenders to improve liquidity and continue operations. American Car Center, which has more than 40 dealerships across 10 states, is owned by York Capital Private Equity Group, hedge funds. The long overdue collapse, the first of many, comes as more Americans are starting to fall behind on their car payments, and the distress cycle is rapidly accelerating. Used car sales are falling in the US, you can see there, gradually. Think of it as the infamous New Century. Yeah, New Century, I think, was the first subprime mortgage lender that went bust, that signaled the collapse of subprime housing only for cars. Just before the announcement, American Car Center shelved the bond deal backed by subprime loans, citing conditions despite investors placing orders for the debt. It wasn't clear why ACC backed down in the last moment, as the alternative was liquidation. However, since many more auto subprime lenders will now follow in ACC's footsteps, we are confident the answer will emerge. Meanwhile, we can't help but be amused by the mind-blowing divergence in Wall Street mental models, where on one hand speculation that used car prices are somehow surging has sent risk assets lower, driven by fear of a rebound in inflation, while on the other, companies like ACC and Carvana are either liquidating or on the verge of doing so, simply because the used car auto segment has completely imploded. So there you go, something to keep an eye on. And you might ask, if this happened in 08, 07, 08, how come it's happening again? Well, I recommend you watch The Big Short. It's a great movie about the 08 crisis. It talks about what happened then. And towards the end, there's a scene where they talk about, they say, well, don't worry, because everything has been fixed. Loads of people have gone to jail, and we reformed the system. And then they say, oh, actually, no, they actually bailed out the bad actors, and they didn't change anything. So that's why it's happening again. And yeah, I spoke to John Titus last week, and I asked him what would bring the system down. And he said, our system is based on loans. And he said something will give, and people are going to stop paying their loans. And I think this could be it, John. So there you go. With that, let's quickly look at where the markets are this morning then. It's 8:15 a.m. London time, of course. We've got spot gold at 1807. It's down about $10. So we're right near the lows. Low has been 1806.86. High has been 1819. So we're down 0.5% in spot gold. Silver is down almost 18 cents at 20.43, right on the lows here, down just under 1%. But we've also got the Dow future down 1/3, or 100 points. We've got the NASDAQ 100 future down 0.4, and the S&P is trading at 39.68, down 1/3%. FTSE as well is down 0.5%, the FTSE 100 index. To the currencies, we got sterling down about 0.25% at 120.32. We got the euro down 0.1%, trading just below 106. And we got the dollar up 0.5% versus the yen at 136.80. Dollar's up slightly versus the yuan at 696.25. So we move to the other currencies. The Aussie dollar, that's down 0.5% at 67.07. And the dollar is up 0.2 versus the Canadian dollar, just below 136. And the Kiwi dollar is down 0.5% at 61.35. To the general commodities, we've got platinum down about $9, trading around 9.34. We've got WTI crude up 1% at 76.50, while Brent crude is up 0.7% at 82.73. And we've got high-grade copper testing the 4 level, and it's down about 0.25%. So let's look at the bond markets, which are very important, as I've said many times. The government bond markets set the scene, set the trend as well for all other markets that are to do with borrowing and lending. So the 10-year yield right now is up over 3 basis points overnight. It's trading at 3.96. That 4% level will be important, of course. And the 6-month T-bill is at 5.15. So just shows you how inverted the curve is. The 2-year is up 3.5 basis points at 4.82. Back to the UK gilt market, government bond market. And yesterday I was talking about the 2-year note gilt yield, that there was some kind of change. So I figured out what happened. Up until late Friday, they were quoting an old 2-year note. And you can see that when the government issues a 2-year, the Treasury, after a year, it is still the old 2-year, but it has a maturity of 1 year. So what happened is that the data providers had been quoting an old 2-year that became really a 1 year. And the 1-year rate, of course, is near 4%. But now they've changed to a gilt that matures in June of, I think, is it June 2025? So that is slightly more than a 2-year. So they changed that. And that's why the rate was adjusted. There wasn't anything really nefarious there going on. So right now, nevertheless, the 2-year yield here, according to investing.com, is up another 9 basis points at 3.76. So it has risen fairly sharply. The 10-year is up another 9 as well at 3.90. And the 30-year now is above 4. It's comfortably above 4. It's at 4.22. It's up 9. During the gilt crisis of September of October, I think that 30-year went above 5%, and that's when the Bank of England panicked. Are we seeing panic yet? Not really, but we really need to keep an eye on this. And yes, for the last 2 weeks, it's just been rising and rising yields, and that's not a good sign. Yeah, we spoke about these subprime auto loans. I'm not sure how big they are in the UK, but I would say they're probably around as well. Because whatever happens in the US in terms of finance, as we saw in 2008, we had subprime mortgages here too. I'm sure there's subprime auto loans here too. So it will be interesting to see what happens over the next few months. If there's going to be other subprime auto lenders like American Car Center, if there's going to be more coming unstuck. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.